I get this question all the time. Which one is better, IPOs or SPACs? Well, in this video, I'm going to put this question to rest for good. What's going on, investors? My name is Jose and welcome back to Rico Suave IPOs, the best place to learn about new companies going public and how to invest in them. Today, we are going to look at the difference between the IPOs and SPACs so you can decide which one is best option for you as an investor. Last year, without a doubt, was the year of IPOs and SPACs. Their popularity has never been greater. According to stockanalysis.com, there were a total of 480 IPOs in 2020 compared to just 233 IPOs in 2019. And according to MarketWatch, a record 82 SPACs went public in 2020. For this video, we're going to compare the IPO SPAC process, their valuations, their popularity, and their trends, as well as their performance in recent years and the risks involved with both of them. So sit back, relax, and enjoy. Also, don't forget to subscribe. A quick shout out to my patrons. Your generosity and contributions allow me to do what I love to do and keep the channel growing, so thank you. If you like my content and want to see more of it, then please consider supporting me on Patron. I've got 3 different tiers full of benefits like portfolio updates, private Discord channels, and a one-on-one phone call. During IPOs, companies will file on the Form S-1 that details the company's proposed ticker symbol, financial data, and use of proceeds. They select several banks to serve as underwriters and sell company shares to the public. They choose an IPO date once the SEC has approved their filing. A simple process where investors are normally familiar with the company that's about to go public. When we compare this process to the SPAC process, we find that the SPAC process is much harder to understand for beginning investors. SPACs are called blank check companies, where investors, they pool all their money together, but the private company to be acquired remains unknown. The SPAC is then taken public under a generic name or a ticker symbol as a shell company. The SPAC sponsor has 2 years to complete the merger or the acquisition of the private company. Investors in the meantime can buy shares, also called units, of the shell company and options, also called warrants, to guarantee them a strike price and prevent them from overpaying if the share prices go up in the future. Investors can back out of the deal before the merger date if they don't like the company the SPAC is about to acquire and merge with. As you can see, IPOs are much more easier to understand and to participate in. If you need help understanding SPACs, please visit my good friend Jason over at JMag Investing. For simplicity of execution, winner, IPOs. Number 2, fair price and valuation. The biggest flaw I see, and I have experienced myself during IPOs, is how the stock prices get inflated during the initial IPO pop. Depending on market sentiment and volume, underwriters sometimes double and even triple share prices, and retail investors like you and I, we get screwed by big hedge fund managers and industrial investors. You see, they get to buy shares prior to the IPO date at a lower price. Is this fair? I don't think so, and I know many of you out there feel the same way. Now, some brokers like Fidelity will let you participate in IPOs prior to the IPO date if your bank account balance is either $100,000 or $500,000 in assets. You'll be asked to enter an indication of interest, IOI, but the IOI must be for a minimum of 100 shares, guys. Now, let's be honest, I don't know anyone out there with this kind of money. IPO valuation is set by whatever the investors think the company should be valued at, and shares are sometimes costly and time-consuming for companies. Now, private companies can go public way faster and cheaper via SPACs. SPACs offer initial price stability and valuation for investors like you and I. According to the SEC, in the IPO, SPACs are typically priced at a nominal $10 per unit. You don't have to worry about overpaying and valuations running amok with SPACs. Winner, SPACs. 3, popularity and trend. If you're wondering why SPACs have become so popular in recent years, it's no coincidence. SPACs are normally sponsored by public figures and senior investors. Investors sometimes can buy units for as little as $10, as I mentioned before. The money goes into a trust fund that is managed by separately from the sponsor, and investors always have the right to get their money back if they are not satisfied with the acquisition. Now, therefore, SPACs have become extremely popular with investors like you and I. Supply and demand also ensures that SPACs will be here in the long run. According to Dr. Patton from Excelsior Capital, the number of public companies have gone down dramatically over the last 20 to 30 years, dropping from 8,000 to just over 4,000 today. But the amount of money flowing into the public market has increased. Because the stock exchanges make their money by bringing on new companies, they push to bring more SPACs every year into the market. Investors love them, and so does Wall Street. Winners, SPACs. Number 4, performance and returns. In 2020, IPOs outperformed the S&P 500 by a large margin according to the Renaissance IPO Index, with companies like Snowflake, Airbnb, and DoorDash as the most popular. If you have not seen my video on the best IPOs of 2020, you should go and check it out. There's going to be a link in the description below. When we look at the SPAC performance, however, Renaissance Capital suggests that of the 313 SPACs IPO since the start of 2015, 93 have completed mergers and taken a company public. Of these, the company shares have delivered an average loss of minus 9.6% and a median return of minus 29%. When compared to the return of 47% of the traditional IPO since 2015, only 29 SPACs in this group, 31% have positive returns. The SPACs years include DraftKings, Virgin Galactic, and Nikola. According to Barron's, once the merger closes, the SPAC shares convert to shares into the target company. Performance on average has lagged behind both the S&P 500 and the Russell 2000 over the following quarter, half a year, and year. It seems SPACs get a strong start, but returns dwindle post-merger. When we compare the SPAC median return of only minus 29% to the IPO aftermarket return of over 47%, we have a clear winner here. Winner IPOs. 5. Risks. The biggest risks involved during IPOs are inflated valuations, as I mentioned before, that often make no sense when compared to the company's profitability. In the last year, only a handful of IPOs were from companies that were profitable companies like GoodRx or Upstart. In fact, non-profitability is the number one reason companies go public and raise funds. Now, how much will they raise? It depends on the market sentiment. Now, remember, just because a company files for IPO, it doesn't mean that the SEC is going to approve that IPO. Many IPOs often are delayed or withdrawn completely. It's important to know that not all SPACs materialize. In that case, the money's returned to the investors. No harm, no foul, right? Well, wrong. There is such a thing as an opportunity cost, meaning while your money is tied up into a particular SPAC, it cannot be used for other investment opportunities. Also, the lack of scrutiny from the SEC have produced some less than honorable SPACs in the recent years, like Nikola and Luckin Coffee. Now, I thought this battle was gonna be a draw, guys. I really did. Then I remember another risk associated with IPOs. If you buy shares of an IPO pre-IPO date, they have what is called a lockup period, where you are stuck with those shares for the next 180 days, and you cannot sell them forward. If the price of those shares drops, you might take a big hit. With SPACs, you are safe if you get out pre-merger. Unless you hold post-merger, winner, SPACs. With a score of 3-2, SPACs take the win. Now, I know this is an IPO channel, guys, but I must be fair and impartial. You have a higher risk when investing in IPOs, but you also have a higher rewards and returns possibility, as I explained in round 2. I hope I answered all of your questions. Let me know if you know which process do you prefer in the comments below. As always, guys, thank you so much for tuning in. Take care of yourselves, and I'll see you soon.
I bring up the pain, Rico solves the mind. I make the market rain like acid rain. An investing channel you ever known, ya. I take your girl, your house, your money, and leave you broke, son.